Hello, and welcome to Citron Cooperman's FINOP Roundtable. I'm Alex Reyes, a partner and financial services industry practice leader for the firm. I want to take this opportunity to thank each of you for joining us today. Citron Cooperman is a top 25 accounting and consulting firm with 17 offices in the U.S. and also offices in London, India, and Cayman. The broker-dealer industry is a key segment for us in financial services, and we provide a wide range of professional services for our clients. This is our 8th year hosting these roundtables, but the first where we're having it virtually. The good news is that by having this virtually, we're able to open this up to many more participants, and this is our largest FINOP roundtable yet. COVID-19 has forced many companies to pivot and adjust to this new normal. It's changed how companies operate today and likely over the long term. Today, we put together an incredible group of speakers that will cover some key topics impacting you, including the payroll protection programs and its effect on net capital, recent regulatory developments, CARES Act tax provisions, and some top state and local issues resulting from COVID-19. Before we get going, just a couple of housekeeping items to cover. You can earn 1.5 CPE credits with your participation, but you must reply to 3 polling questions to receive the full credit. You joined in listening only mode, and you will have an opportunity to submit questions to each of the presenters. Just type your questions into the Q&A icon on the panel, and we'll address all your questions at the end. The session is being recorded, and a playback link will be sent. At the end of the roundtable, there will be an evaluation form, and we encourage you to fill it out. Now, it's my pleasure to introduce my fellow partner, John Cavallone, who will discuss the Payroll Protection Program and its effect on net capital.
We're going to talk first today about the implications of the payroll protection loan and the possible forgiveness of that loan on your regulatory net capital. So the first question that I'm sure most folks have is, can that forgiveness, can the expected loan forgiveness help the firm with its net capital? And the short answer and the good answer is yes, it can. Finra has put out some guidance specific to the forgiveness and what a broker-dealer would need to document in order to add back to net capital on a current basis the loan forgiveness that the broker-dealer reasonably expects will be forgiven when the loan application, the forgiveness application, is submitted to the lender and then ultimately to the SBA. In order to avail themselves of the guidance that Finra has put out, the loan must be recorded on the books of the broker-dealer, assuming, of course, the broker-dealer was the one who applied for the loan, as a liability on its balance sheet. Clearly, amounts that a broker-dealer adds back cannot exceed the amount of the loan received. That kind of goes without saying. You can't add back a loan forgiveness in excess of your loan. When a broker-dealer does the calculation for the loan forgiveness, they're eligible to add that back on their focus report on a current basis. So as we are now closed out the month of May, many broker-dealers are beginning to assemble their books and records and prepare to file their focus reports coming up sometime in probably the next 2 weeks in June. You can add back and report on line 3525 of the focus, which is other deductions or allowable credits, the amounts that you reasonably expect will be forgiven when you submit your application to your lender for loan forgiveness. Now, there's some good news we're going to talk about in a little while as we go through the outline here. regarding the loan forgiveness and the time period. But the important thing is, this is relevant now as you're preparing your May focus reports. Go through the calculation on a rough basis to determine what that forgiveness should be and report it on line 3525, and you've increased your capital. Another key that FINRA required in their announcement on this is that the broker-dealer must maintain the supporting documentation, including how they calculated the amount that they estimated to be forgiven. Now we're going to go over on the next slide, please, some of the items that are eligible for forgiveness. And these are all things that you should maintain in your documentation. So the first thing, as we've all, I'm sure, heard, is one and the main area of expense that is eligible for forgiveness is payroll costs. And there have been a tremendous amount of questions surrounding what's eligible, who's eligible, where's the cap, do you include certain expenses, do you not include certain expenses? And basically what you can do is you can include as eligible expenses for forgiveness, salaries, wages, commissions, very important in the broker-dealer world, or similar compensation, up to $100,000 prorated annual compensation. So that breaks down to approximately $15,385 during the 8-week period. And we're going to talk more about that 8-week period in about 2 slides, for purposes of the loan forgiveness. You can include tips, probably not relevant here for broker-dealers, but broker-dealers were considered an essential business. And if you maintained your office and you had people going to the office to open mail, keep things moving, answer phones, do whatever the case may be, you might want to consider paying a little bit of bonus compensation to those individuals, because it would increase the amount eligible for forgiveness. But of course, it's not going to do you any good if it's going to be in excess of that $15,385 number. So some consideration would need to be given with regard to that. Folks that have taken vacation, sick, medical leave, parental leave, or any of the sort, and received payment during the period, the covered period for the loan forgiveness, that would also be eligible. Severance, if you happen to separate a number of employees, the severance payments would also be eligible. And then of course, group health care benefits, insurance premiums, any retirement benefit. The key with the retirement benefit is that it should be paid in the ordinary course. So if your company made its matching 401k contribution in December or in January, as a matter of practice, making a 401k contribution in June or July probably would be frowned upon for purposes of loan forgiveness. State and local taxes that are assessed on any of the compensation that is paid during this time period. Now, it's the employer portion of the tax, not withholding tax that is withheld from the employee's compensation. So state unemployment, maybe metro transportation tax, things of that nature. And then of course, owner's compensation is also eligible if it's reported on a K-1 as guaranteed payments. Again, it's subject to the same limit, $100,000 or $15,385 during at least the initial 8-week period. Other expenses eligible for forgiveness is rent. The leases, of course, had to be in effect before February 15th of 2020. Utility costs, I think some of the ones that folks might not be paying attention to or thinking about would be water, sewer, internet, phone. The interesting thing there with regard to internet and phone is if you have people that are working from home and you are reimbursing them for their cell service now, or are paying their internet costs because they maybe needed to upgrade their internet speed or something along those lines, consideration should be given as to whether or not those costs should be included in the forgiveness amount. And then interest payments. Interest payments are for a mortgage obligation, and the definition in the CARES Act of a mortgage obligation is it has to be on real or personal property. So that would kind of eliminate mortgage interest or interest payments on subordinated loans because it's not real or personal property. The indebtedness needed to be incurred before our famous February 15th, 2020 date. And the amount eligible for forgiveness would exclude any principal payments that were made or included in the payments that were made during the period. So treatment of amounts not expected to be forgiven. Well, during the 8-week period, covered period, the whole entire loan is considered non-AI. So you don't have to worry about its effect on your net capital for purposes of the aggregate indebtedness computation. But after the covered period, amounts expected to be forgiven can be excluded from AI, and those would be reported on focus line 1385 or 1380, which is other non-aggregate indebtedness. Amounts not forgiven are, it looks like a typo here, sorry, but amounts not forgiven should be included in AI after the forgiveness period. Just keep in mind, it shouldn't be a major issue for most firms, but you could run into an issue with the debt-to-debt equity ratio when you now have, if you have a significant portion of these loans that are not forgiven, your debt-to-debt equity ratio can exceed the 70%. You have 90 days to cure that, as you know, I'm sure, but just keep that in mind as you go through the calculations. Additionally, annual assessments. So FINRA, in their infinite wisdom, was kind enough to allow firms to defer their annual assessments. So there's some deferral options. The interesting thing with regard to the deferral options are, it's just an option to defer the payment. You still must follow GAAP and record the liability and the appropriate expense. But for the period of time through September 1st, 2020, currently it would be allowed as an add back, that deferral would be allowed as an add back to net capital. So what we don't know, well, currently as written, the legislation is your covered period for loan forgiveness is 8 weeks. As you may or may not know, there has been some legislative action in Washington, D.C. Last night, the Senate approved a compromise bill between the House and the Senate, and it's been forwarded to the President. The Senate bill actually wanted to extend the covered period for the payroll protection forgiveness to 16 weeks. The House bill was 24 weeks. The bill that has been submitted to the President for his signature is now 24 weeks. Now, unfortunately, most folks have had their payroll protection loans for at least 4, and in some cases close to 8 weeks already. So you may have spent all of your money calling back people that you didn't have work for, or incurring other costs, and there's nothing left for that 24-week period. But it's currently expected that the President will sign that bill And the 24 weeks will now be the period to measure your payroll costs to determine forgiveness of the loan. Additionally, in that bill, only 25% of payments using those loan proceeds were eligible to be spent on non-payroll items. The bill before the president now increases that 25% to 40%. So now you can pay even more utility bills and rent and things of that nature, like maybe your accountant's bills or legal bills or some other bills that might have been piling up during this period of uncertainty. So we now have clarity once the president signs it. It'll be 24 weeks and it'll be 40% cap on non-payroll costs, which is all good news, except it would have been great to know this 5 or 6 weeks ago for most companies. Next slide, please. I wanted you to have access to some of the guidance that will be very, very important in determining the forgiveness. So first is our Citron Cooperman website, where we have our COVID response unit, and there's all sorts of information, webinars, tax notices, all sorts of guidance that is there on that website for you. The next link that is there is the link to FINRA and where the Finra Guidance is. I'm specifically pointing you to the posting on April 2nd of 2020, which is where they put out their guidance on the loan forgiveness if you wanted to see the actual FINRA correspondence that they put out. And then the final website is an AICPA website. Unfortunately, the address would have filled up the rest of the page and probably 2 other slides. So I say you just got to follow the links. But the AICPA has an Excel spreadsheet that is designed to walk you through the loan forgiveness calculation. There's some items that need to be input by you. There are some items that carry over. There's some questions that you have to answer that then populate the loan calculator. But I think you'll find this to be a pretty useful tool, and it would certainly be something that I would add to my documentation for the amount that you are adding back in your net capital computation on line, what was it, 3525. I would add that Excel spreadsheet and maintain that Excel spreadsheet as your support for that calculation. At this point, I'd like to turn the presentation over to my partner, Dave Groomer, who is going to further discuss some of the recent regulatory developments as it reflects the broker-dealer industry. Thank you.
On April 22nd of this year, the SEC published its 2 frequently asked questions that have been very widely read. First, about prompt transmission of customer checks, and the second about quarterly securities counts, physical certificates. So the relief is granted with the understanding, firstly, in the court in respect of the transmission of customer checks. First condition, checks should be deposited or transmitted, I should say, as quickly as one can. Secondly, notify your customers. Explain to the customers, number 1, they should be remitting to the clearing brokers or online. And number 2, the processing of their payments may be delayed. And the third condition is that there be notification to the regulators. The regulators, SEC and FINRA, want to know the current situation that you're facing, and also want to know what have you notified the customers. Second matter in their frequently asked question is relief for the quarterly counts of securities. Again, notifying the SEC and FINRA. Secondly, maintaining a bookkeeping summary of the movements of physical inventory. Keep track of what has been received, what has been delivered, and what is the amount of inventory that you were unable to count. And the thinking behind that is that if you can't get to your securities to count them, there's likely not going to be much changes in your inventory. Next item I want to cover is registered investment advisors. Broker-dealers are often parts or components of larger organizations, and there may be a registered investment advisor as part of that group. And I wanted to give you some information about relief for them as well. Frequently, a registered investment advisor will design their operations so that they comply with the custody rule. Complying with the custody rule may mean they have the opportunity not to be subjected to a custody exam. One of the first requirements is what constitutes custody. And for purposes of a registered investment advisor, if securities are brought in or received from a third party, there's a 3-day timetable in order to determine whether or not there's custody. If securities that were received from a third party haven't been moved over to the custodian, or if securities from a customer haven't been returned within 3 days, that could constitute custody. The relief is that that 3-day period will begin once personnel can access their mail or deliveries. Secondly, it is possible to get an additional 45 days to file the custody exam report if either the auditor or the advisor are experiencing disruptions due to COVID-19. The report is due in 120 days from the date of the surprise examination. The question you might ask is, that's great. What is the procedure to get that extra time? And unlike other regulatory requirements, there is no procedure that I've ever seen. Advisors, on occasion, I've seen it very rarely, do ask for additional time. And if they do, it's necessary for them to contact the SEC and inform them of the situation. And I would expect communication would be in their interest. And if you need the additional 45 days, there should be communication with the SEC. Next is relying on timely distribution of audited financial statements and pooled investment vehicles usually is based on the expectation that there won't be any unforeseen circumstances. In other words, you don't make that determination when the financial statements are being completed. It's when you begin to plan your audit or when you begin to arrange for the audit to take place. Usually we talk in terms of distributing the audited financial statements of pooled investment in vehicles within 120 days or 180 days or even 260 days, depending on the nature of the fund. So this is a reminder. Jessica, let's go back for a second if we could. Thank you. This is a reminder that COVID-19 also represents unforeseeable circumstances. And if you need more time, it would not result in enforcement actions. Next slide, please. The fourth relief relates to privately issued securities. What do you do if the RIA receives privately issued securities? They're required to deliver those securities to a qualified custodian. What if the qualified custodian, typically a bank or another broker, what if they're closed? What if they're not open? So there are some conditions relating to how you can protect your compliance with the custody rule. And one is to safeguard those securities. That's the registered investment advisor's role. And the third, let's look at the first 3 bullets here. They revolve around the difficulty, the relative difficulty in arranging for a transfer or negotiation of those securities. So if those securities meet the definition in the first 3 bullets, then you can qualify for this relief. Next slide, please. FINRA. For broker-dealers that file Part 2A or that are subject to the exemptive provisions K1, K2I, K2II. They can receive an additional 30 days to file their annual reports if their fiscal years end between January through March of this year. And by the same token, monthly or quarterly reports, FINRA says you can take an additional 10 days if your period ends between February through April 2020. So what this means is that the procedures that are in 17A5 as well as the related interpretations are waived. Does the additional time provision apply to brokers who are required to distribute financial statements to their customers? And the answer is no. Next slide. A reminder from FINRA about AML testing. It does happen that some people believe that they need to get their testing done within 12 months of the prior test. And FINRA just sent out a reminder and they said, please keep in mind that testing is on an annual basis, whether you're in a 1-year or a 2-year cycle. So if you did your AML testing last April and you're worried that your 12 months since April are going to expire, the reminder is you have the rest of the year to do your 2020 testing. Just, it's not all about focus reports, and the business continuity planning regulatory notices cover a wide variety of topics that may come up as you try to timely comply with any number of compliance requirements, advertising, U4s, notifying FINRA of any kind of thing. And the message here from FINRA is contact us, talk about it. Should a member firm document that it has relied upon any temporary relief provided by FINRA from obligations and rules or requirements during the COVID-19 pandemic? So the answer is yes. Do document any changes, whether they're temporary or permanent, in your written supervisory procedures. Also, you should keep track of any verbal or written communications or emails between the regulators and yourself explaining the situation. This FAQ was posted on May 21st, which was about 8 weeks after everyone started working remotely, but the message yet is still there. Now, I was on the phone with FINRA yesterday, and I posed this question to them because part of that FAQ says public disclosure by a member firm of its reliance on relief by FINRA may be appropriate in certain circumstances. I did ask the people I was speaking to at FINRA, what did you have in mind? And there was no answer. So I guess that will be taken on a case-by-case basis if there is a perceived need to make disclosures. Okay, CFTC. CFTC is offering us very much the same relief for the Paycheck Protection Program as is FINRA. In addition, a duly registered broker, whether they're an IB or an FCM, that is registered with SEC, is also going to get the benefit of the adjustment to net capital for the unpaid annual assessment fees. I shouldn't say adjustment to net capital, adjustment to minimum financial requirements. Next slide. Filing reports. Again, for your annual report and for the interim reports, IBs, introducing brokers, get the same, very similar relief that FINRA is offering, and the relief is automatic. Last slide. There is if you're working with commodity pool operators, there's a very detailed notice to members from NFA, I-20-15, about filings on behalf of commodity pool operators. What CFTC or what NFA is saying is that additional time is provided to provide statements, financial statements to pool participants for annual as well as interim financial statements. In many cases, it's 45 days. If there's a case of extreme hardship, there could be an additional time up to a total of 90 days from the original due date. And that concludes my conversation about regulatory notices. Our next speaker, I have the pleasure of introducing Paula Rossi, who's going to speak about CARE Act tax provision. Thank you.
Thanks, Dave. Good afternoon, everyone. I hope everyone and their families are doing well. Today, I wanted to address a few key items with regards to the CARES Act that I believe will be important and potentially could yield some tax savings for those that, kind of find these opportunities. Just as the slide would mention, I'll be discussing the refundable retention credit, the payroll tax deferral, net operating loss, followed by section 163J, which is the business interest limitation, and then lastly, the qualified improvement property, also known as the QIP. Next slide, Jess. Next slide, please. Okay, thanks. So with regards to the refundable retention credit, there are a few factors that I wanted to touch upon. First, that the credit itself, and then followed by the pay period. The retention credit is a refundable tax credit against your certain employment taxes, equal to 50% of qualified wages an employee pays to employees after March 12th, 2020 through January 1st, 2021. So again, this is something that's been pretty interesting, and clients have taken the opportunity to look at stuff like this because, again, it is a tax refundable credit, and it's a good opportunity, obviously, to potentially get some savings here. As we look further into this, there are various thresholds and certain things that we kind of need to look at to determine whether or not you could avail yourself of this credit. Obviously, again, it's equal to 50% of the qualified wages, and the period is that March 12th, 2020 through January 1st, 2021. So essentially the end of 2020. They look at the credit with regards to two different sectors, meaning the amount of employees a company has. So first off, if we look at for businesses that have more than 100 employees, the qualifying wages are limited to wages that were paid by the employer to an employee that was not providing services during the quarter for the period of time the business was shut down. So again, they look solely to the fact for those employees that were unable to go to work because of the shutdown. And then secondly, the entities or the businesses that have 100 or less, the calculation is similar to having the 100 or more employees, other than they look at twofold. They look at qualifying wages, again, wages that were paid during the shutdown, or two, wages paid for each quarter that the business suffered a significant decline in gross receipts. So again, they're a little bit more lenient with regard to the amount of wages that you could use for those businesses that have obviously less than 100 employees, where for the businesses that, you have more than 100 employees, they just look at the period where an employee was not providing services. But however, for the businesses that have less than 100 employees, they look at it, you can opt to either look at wages that were paid by the employee during the shutdown, or wages paid for each quarter that the business suffered a significant decline in gross receipts. And when they look at the definition of significant decline in gross receipts, because that was something that, business owners were always wondering, what does it mean when, we have a significant decline? Obviously, during this period, anyone could make the assumption that they had a significant decline in gross receipts. So what the CARES Act did is they identified that there was an issue with regards to what this definition meant. And what they put in the act is that they said a significant decline in gross receipts takes place during any quarter where gross receipts for that quarter are less than 50% for the same quarter in the prior year, and continue until gross receipts exceed 80% of gross receipts of that same calendar quarter in the prior year. So again, the testing date really begins with the first calendar quarter of 2020, and they want to look at it from almost like an analytical standpoint, meaning let's look at 2019, let's look at 2020 and compare those types of gross receipts and see if we fall within or below this 50% and 80% threshold. So again, I think it's a good opportunity for everyone to kind of look at to see if you fall in this significant decline in gross receipts and maybe get the opportunity to have this refundable credit. Next slide, just. Okay. Keeping the, kind of the mode with regards to payroll, another opportunity, not so much refundable, but more as the topic heading states, is this is really more of a deferral. So, the next topic, so I'll discuss what the deferral is, and what it really comes down, it's pretty straightforward. And again, this is another opportunity for everyone to kind of look at, to say, okay, maybe this is not an economic outlay right now, but obviously it will be as I get to the deferral periods. But again, it's an opportunity or a tool that we could use to, try to harvest as much cash as possible during these times, given the opportunity that we could defer these payments, in the upcoming years. So the payroll tax deferral, it allows employees to defer 100% of the employer portion of payroll taxes. And for those individuals that are self-employed, you're allowed to defer 50% of your self-employed taxes. So, you really have to look at this twofold. You have to look at it, one, from a business perspective, and then secondly, to the extent that you're a sole proprietor or a sole practitioner, you have the ability to defer your payroll taxes as well, or i.e. your self-employment taxes. So again, when we look at this from a business standpoint, you're allowed to defer 100% of the employer's portion of the payroll taxes. Again, if you're self-employed, it will be 50% of your self-employment taxes. And the deferral applies to payroll taxes due for the period beginning the date that the CARES Act was signed and ending December 31st, 2020. So what's interesting enough is that you can effectively defer half of the payroll taxes to December 31st, 2021, and then pay the remaining 50% in December 31st, 2022. So again, not as lucrative as the credit, because that's refundable, but it could yield some benefits because, again, from a cash flow perspective and an economic standpoint, you have that ability to make these payments, in a year and 2 years from now. So again, something that you should probably look at a little bit more closely. Okay, Jess, you can go ahead. Thanks. All right, the topic of NOLs, this is something that has been looked at closely, and here, coming from the tax side, this is something that could yield tremendous opportunities, obviously, if it fits. We've done an analysis on certain clients that we had, and we found that there could be some potential opportunities for tax refunds because of this new enactment. So what I'll go through is really the prior 2018, just to kind of give everybody a little bit of history, and then the involvement of the TJCA, and then obviously the new bill, which is the CARES Act, and kind of walk through the modifications that they made throughout. So prior to 2018, the NOL could have been carried back 2 years and forward 20 years with the ability to offset 100% of taxable income. So prior to 2018, if you had a net operating loss, you had the ability to carry it back 2 years and then forward 20 years. And what that did was, to the extent that you had any taxable income in those respective years, you were able to utilize that net operating loss dollar for dollar against your taxable income for that year. Along comes the TJCA, and what they've done is the TJCA says, well, we're going to adjust the net operating loss computation. And what they've done is they changed the rules by disallowing the carryback of post-2017 losses, and only allowed a carry forward limited to 80% of taxable income. So if you had any losses that were incurred post-2017, and again, this is because it was so short, it was really for a 2-year period, you were only able to utilize 80% of those losses against your 2000, and let's call it 19 income. So if you had a 2018 loss of 100,000 and you had 2019 income of 100,000, pre-bill, you were only able to offset $80,000 of that $100,000 of NOL. So it put taxpayers in a position where they incurred losses in the current year, they incurred income in the current year, but they weren't able to offset dollar for dollar with their net operating losses. So it really put people in a bad situation where they thought they had enough net operating losses to cover them against that income, but obviously with the enactment, it was really only 80%. So again, just to kind of give a little bit of history, so you started pre-2018, you were able to utilize everything. The enactment comes out, they say, okay, you can still, there's no carryback for NOLs, you can only carry it forward, but you're only able to utilize 80% of your NOL against future income. The CARES Act comes in, and they made three pretty, what I believe, pretty significant changes to the NOLs that obviously could improve cash flows for businesses that we know now that are currently hurting. And the three main topics that they kind of discussed with regards to the NOLs are as follows. They provided for a 5-year carryback for losses incurred in 2018, 19, and 20, which allowed taxpayers to actually go back and amend 2013's tax returns and potentially get some refunds for taxes that they paid in 2013. So again, just looking at it from an overall economic standpoint, to the extent that you had losses in 2018, or let's say 2019, you're able to go back as early as 2013 and offset dollar for dollar any income that you incurred in those years. And any tax that was paid in those years, you would obviously request for a refund. So again, it could be a good opportunity for those in the C Corp world that had these suspended losses or these NOLs that we can now carry back and maybe get some potential refunds. The second item with regards to the NOLs was that they suspended the 80% taxable income limitation. So now a corporation can offset the entire taxable income instead of just the 80% that I alluded to earlier when the TJCA enactment came into place. So again, this is a good opportunity that, to the extent that you have NOLs and you're not carrying them back and you want to carry forward, you now have the ability to utilize 100% of those net operating losses against future profits without worrying about this 80% haircut. So again, a good opportunity and a real good way to kind of analyze whether or not it makes sense to go back and amend the prior year's tax returns to potentially get some tax dollars back, or do we make the election to forego the NOL carryback and offset future profits with the net operating losses that we have kind of in our back pocket? So again, an analysis that could be done and just to see from a tax effect what makes more sense, whether it's amending the 2013-14 tax returns, or do we forego it and then utilize those net operating losses on a roll-forward basis? The third item, which I believe to be probably one of the most important and really hits all the individuals is the fact that historically pass-through owners of businesses were limited by the amount of losses that they can take from their partnerships or their flow-through income against other income that they had on their personal tax returns. So for example, if you had someone who had $100,000 loss from $1 million loss from a K1, but they had $1 million of investment income, the old law said that you were not able to offset dollar for dollar your pass-through loss against non-business income. And it's what's known as the excess loss limitation under 461L, I believe. And what they've done there is it really hurt a lot of individuals because where they had losses from these businesses, but they were not able to utilize all of them against the non-business income, which put them in a tax-paying position, even though they had these losses from their companies. So what they've done is they said, and that limitation was $500,000 for those married filing jointly, and $250,000 for those that are filing single. So you're only able to utilize $250,000 or $500,000 of that loss against other income. Anything excess of that, the individual was stuck paying tax, even though they had sufficient losses to potentially wipe out all the other non-business income. So what they did for on the new bill is they said, look, we understand that this is something that's really hitting hard, the individual taxpayers. So what they've done is for pass-through owners, they may use the NOLs to offset their non-business income above the previous limits. So again, this is a great opportunity for those that had business losses and were not able to utilize all of them against their non-business income, whether it's interest, dividends, capital gains, because of this excess loss limitation. You can now go back for those individuals that filed, obviously in 2018, and those that may have filed early in 2019, to go back and amend your returns to, provide yourself with this refund potential. So again, something to look at as you're looking at your individual returns to see if you can benefit from these net operating losses, and secondly, if you can benefit from this excess loss limitation. Next slide, Jeff. The 163J, again, this was something that was put into place to potentially limit the business interest expense. This was something that, we took a lot of time kind of understanding, and then obviously they come out with these new rules. And what's happening here is the following, and I'll go through the slide relatively quickly because there's not really much meat here, but more so there's some changes. So historically what they've done is the TCJA came out with rules that potentially limited the amount of interest expense you can take on your on your tax returns, and that interest expense was limited to business interest income plus 30% of your adjusted taxable income. So if you had interest expense in excess of those amounts, it would be limited. What they've done, and that was at 30%. What they've done for 2019 under the new bill, under the CARES Act, they increased the 30% limitation to 50% limitation. So instead of when you're calculating your business income, your business interest income plus your adjusted taxable income, instead of using 30% of adjusted taxable income, you can now use 50%. For partnerships, the rule didn't change for 2019, but it did change for 2020, where they're allowing the 50% rule for tax years in 2020. One caveat that I wanted to mention that's really important is as you're calculating this business interest limitation for tax year 2020, you are allowed to use 2019's taxable income rather than 2020, because we all know that for a lot of businesses out there, 2020 obviously will result in a lower income than than 2019. So you have the ability to use 2019. All right, I guess the final slide will be regards to the qualified improvement property. Here, pretty straightforward. Prior to the TCJA, they allowed for 100% bonus depreciation on assets with a class life of 20 years or less, which meant that you were able to fully write off any qualified leasehold improvements that were done to the interior part of your business. Again, if it followed the definition of the qualified improvement property. Prior to 2018, it was a 15-year recovery period, but under the enactment of the TCJA, they changed that to a 39-year, which we believe to be incorrect, because once you treated it as 39-year, it disallowed you from taking any bonus depreciation. So this is something that was, kind of fought against, and we believe there should have been a technical correction when the enactment came out. And long and behold, when the bill was issued, they issued a technical correction which said, yep, you know what, we kind of messed up. It's now reverting back to a 15-year recovery life, and taxpayers will now be able to take accelerated depreciation. The beauty here is, to the extent that you've placed assets in service in 2018, you can now do a change of accounting and kind of recoup all that depreciation expense on your 2020 tax return for those assets that you placed in service in 18 under the 39-year life. You can actually recoup all those assets and take full accelerated depreciation and write off the remaining balance all in 2019. So a good opportunity to kind of look at that. And I think that's all I have. Thank you. I'm going to pass it over to my partner, Eugene Revere, who runs our state and local tax.
All right, so this is the stuff I'll be covering here. It's pretty much the stuff I've been eating, breathing, and sleeping for the past couple months. And now hopefully I will also put all of you to sleep. If you're not already asleep, I'll just tuck you in a little bit more. So the next slide. All right, so here we have a little bit of an eye chart as to what's going on from a personal income tax filing and payment perspective. A lot of states have taken action similar to the feds, where they've pushed out the filing and payment dates, but some of the ones in orange, you'll see some unusual things going on. DC and Virginia weren't so beneficial or kind to their taxpayers. And then New Jersey and New York, if you look over on the right in the second quarter estimate column, you'll see an anomaly here where we have a situation where we can file the 2019 return on July 15th. We can pay the first quarter estimate on July 15th, but then the second quarter estimate is due June 15th. There's a little bit of a technical issue here, and it's not very clear what this means. Do we really have to pay the second quarter estimate before the first quarter estimate and before filing the 2019 return? Our positions thus far has been that we think if you overpay on the 2019 tax return, which could be paid in on July 15th, or you overpay the first quarter estimate, that it would apply to that second quarter payment. But both New Jersey and New York haven't provided any clarity. We've been in contact with them and they still kind of just shrug their shoulders. So if we want to play it really conservative, we pay in the second quarter estimate in the next week or so, and then square away the other filing, the 19 filing and the Q1 payment in July, which really makes not a lot of sense, but that's what we're facing. Go to the next slide. So when we think about state taxes and how we figure out what your state taxable income is, we first have to think about how the states look at the Internal Revenue Code. For the most part, that's the starting point for a state in figuring that out. Some states will say that we're going to use rolling conformity. And that means every time that the IRC changes, the state does too. However, in that case, there's the possibility that the state can say, yeah, I'm doing rolling conformity, but I'm going to decouple from certain specific IRC provisions. There's also static conformity. If you could go back, Jessica. But anyway, there's static conformity, right there, thank you. There's static conformity. That means that the state has chosen or picked a date on a calendar and said, we adopt the IRC as of this date, as it existed on that date. But they could in turn say, okay, the IRC we adopted as of that date, but there's some nice stuff that the IRC adopted after that date. So we're gonna pull that into how we calculate state taxable income. And lastly, there are just a few states that kind of do a pick and choose approach, that they don't have a specific adoption date, they're not rolling, they just pull pieces out of the IRC as they like. So clearly there's a lot of confusion here, but it tends to end up being mechanical. It takes a lot of time to sort it out, but we can certainly do that. Here's a listing of the states that we do most of our work in, Citrin Cooperman. You'll see a lot of states as far as the IRC conformity goes, it's rolling. But again, that could mean that there's a bunch of decoupling in there that keeps us from just saying, okay, we're totally piggybacking the IRC when we're trying to figure out what state taxable income is. This chart, just to be clear, is about the corporate tax side. A state could have a totally different rule from a personal income tax or flow-through entity perspective. So you really got to be careful on this front. Don't just say, oh, the corporate rule is rolling. We have to think about what they're doing on the personal income tax side or the flow-through entity side. Next slide. So when we get through that thought process of, okay, you're rolling, you're static, whatever, we then have to apply that to the CARES Act that Paul just went through, what some of the benefits are, and see what the states do. And in doing that, we can look at a couple states just to flush out what the possibilities are. New York, from a corporate perspective, has a rolling conformity. So you would initially think, okay, great. IRC, the feds did some good stuff for us. New York will do some good stuff for us. Not necessarily the case. On the QIP piece that Paul discussed, there will, from a New York corporate perspective, be an adjustment from 39 years to 15 years. So you'll have additional depreciation, but New York on the corporate side doesn't follow a bonus depreciation. So you're stuck there. You can't push it all in and take advantage of bonus depreciation. On the 163J interest limitation perspective, New York State decoupled from a corporate perspective. So again, even though they're rolling conformity, meaning that they're going to piggyback the IRC, they said, well, wait a second, we don't really like this change on the interest limitation, so we're going to back out of it. And from an NOL perspective that Paul spoke about on the carryback, New York just doesn't follow the federal NOL regime. They do their own NOL calculation, so there's no carryback opportunity here. Then on the individual side, we have another interesting twist where historically New York for personal income taxes was rolling conformity. When the CARES Act came out, they said, no, we're not going to do this. We're actually going to static conformity to a date just prior to the adoption of the CARES Act. So everything goes out the window. And even worse, there's a risk here that if you do a carryback from a federal perspective and you're filing a New York tax return, you could actually see your New York NOL go poof and get no benefit at all on the carry forward. So if you do the federal carryback, great, you get a big benefit, which, that may be worthwhile still, but you have to be cognizant that it's likely you're going to lose your NOL from a New York perspective, period. No carryback, no carry forward. Pretty bad news. Next slide. All right, to give you a perspective on how another state handles it, California is actually pretty straightforward. There's static conformity, meaning that they follow the IRC as of January 1st, 2015. So the TCJA doesn't matter, the CARES Act doesn't matter either, unless they choose at some point to adopt certain provisions out of these federal acts. I don't think it's happening. California kind of does it their own way, but it's just, you can see the dichotomy between what's going on in New York and California, and that's just two states. All right, so a lot of that stuff was tax technical This, I think, is more real life. We're having a lot of conversations about personal income tax residency from a state perspective. We're hearing, of course, a lot of people are, say, vacating the city during the COVID period. They left in March. They're not totally sure when they're going to come back. It could be September, could be next year, could be dependent upon when their company's office opens up. So there are a lot of questions about what this means from a residency perspective. My first reaction is, in general, that a temporary stay outside of New York, or any state really, doesn't change your domicile. And domicile, it's really just a fancy way to say that, you know, what your true home is. So if you're just leaving and not really establishing firm ties to a new location, say it's your vacation home, you know, historically you've been a New York City resident and you have a vacation home out in the Hamptons, you've evacuated New York City and you're staying in the Hamptons now, that temporary move doesn't necessarily mean that you can change your residency from New York City to New York State and save that almost 4% tax on from the New York City tax. It can be tricky. There's lots and lots of fact patterns that we need to go through to make sure that we understand the facts and we're applying the rules correctly, but don't flippantly assume that you can change your residency just because you haven't been in your true home for a number of months. And another piece of it is you also have to be careful that you don't trip into a dual residency situation. Some states, including New York, many states really, have a rule that says that you're a statutory resident if you have a home in that jurisdiction and you spend greater than 183 days in that jurisdiction in the tax year. So you could see that if you end up vacating your true home and ending up in some other state or taxing jurisdiction for greater than 6 months, you're then up over 183 days and you've had a home there for the whole year, yet you're still domiciled in your historic home, and now crap, you're now a resident in 2 states. There could be situations where that leads to double taxation of portfolio income. Really bad result. We're not really sure if the states are going to aggressively go after this, but coming out of COVID, we expect that the states are going to have some crazy budget issues and that the audit regime can get very tough. So we really want to make our clients and everybody out there aware of these issues. There was a New York Times article about this recently, and they really just kind of missed the ball on it. It was a good timely article that they brought up an issue that people are talking about, but they made the concepts totally just intertwined and hard to follow. So definitely have a conversation with your tax advisor about this. Then you really need to know the state tax rules before you make a move here. Lastly, another big issue with COVID, sorry, Jessica, just one more piece. The employees working from home. So lots of people, they're working remotely, you know, our firm's working remotely right now. What are the state tax consequences related to that? Does the company now have a state corporate or flow-through entity filing responsibility in the state where their employees are now working remotely? Most states have said, most states that have given guidance on this have said, no, just ignore it for now, it's okay. But there are a good 35 plus states that haven't said anything about it. So we're not really sure which way they're going to turn. We'd like to think that they'll be nice about it and say, yeah, ignore it during the COVID period because that would just be egregious to go after you for taxes. But it's a possibility. The same goes for withholding state unemployment insurance tax. The 10 or 15 states that have given guidance out on this have said, don't worry about it for now. Totally okay. You know, keep yourselves on, keep your employees on payroll in their original state. Illinois, for an example, though, has said that, you know what, we have a 30-day rule. If you have an employee who's been in Illinois for greater than 30 days, that you're going to have to switch over the payroll. So that could be something to watch out for. And the other states that haven't given out guidance on this stuff, again, they could do anything, because normally if you have an employee working in a state, that means that you should be withholding tax from that employee in that state and also paying unemployment insurance tax in that state. But for the last bullet, the convenience of employer rule. New York, Pennsylvania, a couple other states have this wacky convenience of employer rule that says if you have an employee working remotely, that employee's wages could get pulled into New York if, or whatever the given state is that has this rule, if that employee reports to somebody managerially in New York. So there's the possibility that you have somebody working from home and their wages could get dragged into New York, for example, anyway, even outside of a COVID period. So it's something to think about as we see COVID lift and people start going back to the office. There's undoubtedly going to be people that say, you know what, I'm just not comfortable going back to the office, or you know what, I just love working from home. And there are employers who are saying, you know what, maybe we should just be doing this. Maybe we should be saving on rent and downsizing. This convenience of employer rule could still pull back the employee's wages into New York, and the employer actually has to follow that rule too from a withholding perspective. So a bunch of stuff to look out for from a state income tax perspective.
Thank you, Eugene. We do have some questions that were submitted, and I'm just gonna ask the specific presenters these questions. So John, a couple of questions for you. The first around the accounting treatment when the loan forgiveness is established, presumably blessed by the lender or still subject to SBA review. Any thoughts on the accounting treatment?
Yeah, thank you, Alex. So currently the tax aspect or the tax treatment of this forgiveness is going to require the beneficiary to essentially reduce the expense or expenses that were paid with the proceeds of the loan that has been forgiven. So therefore, you're not going to get a tax deduction for the expenses that were paid with the loan proceeds being forgiven. Now, I say currently because there is some expectation that they may change that and not have those expenses be reduced. But currently, that's the understanding. So from a GAAP perspective, while GAAP is not tax, I would think the appropriate treatment would be similar in that the loan would be reduced. So you would wind up debiting the loan and you would credit either the expenses that were paid, the forgiven loan proceeds, or you would record cancellation of indebtedness income on your books and records for the broker dealer. So I think either of those would need to be given some consideration depending on what evolves further from Washington on that.
Thanks, Sean. One other question regarding the 8-week period being increased to 24 weeks and whether that would suggest that the maximum for any one person becomes the 46,155.
Yeah, that's a good question. I would think that that's the intent of the legislation, to give companies more time to spend money and to have greater amounts ultimately being forgiven. I think, unfortunately, some folks called people back before they needed to, before they had work for them, incurred the expense, use the proceeds from the loan that they could certainly use now or shortly in the future as they begin reestablishing their business. So, this legislation isn't even passed yet. So my expectation is that, yes, it would be increased to the 46,000 number, but until it's passed and we get, 4 more interim final rules on it, no one knows for sure. Just one other thing I wanted to comment on when I was listening to what Paul had to say. He reminded me of the other aspect of this legislation that is before the president. When Paul was talking about the deferral of the employer's portion of the FICA tax, or of, you know, actually it's FICA, not Medicare. Originally, that was if you were given a PPP loan and you were going to be forgiven some of that loan, you would only be eligible to defer the FICA tax up until the point in time of that forgiveness of the loan. Under this new legislation, even if you are forgiven a portion or all of your PPP loan, you are still able to do the payroll tax deferral through December 31st. So I wanted to mention that. And I also wanted to mention that apparently someone on the webinar believes that the debt-to-debt equity ratio is not applicable as it relates to the PPP loan. So I will research that. I do believe that it is once it becomes debt, but I will research it a little further and circulate something to the attendees to clarify that.
Thank you, John. I want to pivot over to you, Paul. There was a question regarding the refundable retention credit. And the question was the 50% year-over-year test. How does investment income come into play, or does it not? Does one just look at operating revenue, or does it look at investment income as well?
Yeah, thanks, Alex. So they issued a Q&A, and I think it might be Q&A number 40 or 41. I forget, but they did mention that in addition to the gross receipts, that income from investments and from incidental or outside sources such as interest, dividends, rents, royalties, whether they're derived in an ordinary course, are included. So again, if you, in my mind, and I haven't seen anything to the contrary, that if you have an investment partnership that has, just interest, dividends, capital gains, that's what they're deriving in the ordinary course of business, that would be included. So yes, I think the answer to that, and again, it's Q&A, I believe it's Q&A number 40, but they do mention that interest, dividends, interest, dividends, rents, and royalties would be included. But what you have to watch out for is even though that those are included for gross receipts purposes, it's generally reduced by the employer's adjusted basis in any capital assets sold. So you have to be careful when including the investment income from capital gains that any adjusted basis in the capital assets that are sold is reduced. So, but from the question from an investment income standpoint, I believe that interest, dividends, rents, and royalties that are earned in the ordinary course of business would be included in that gross receipts. I did want to mention, Alex, one thing real quick. I don't know if I skipped over it or not. I apologize if I did, but the retention credit is a max of $5,000 per employee. I know I had mentioned that the qualified wages, that it's 50% of the qualified wages, but the qualified wages are max is $10,000 per employee, and how you get that $5,000 is just simply looking at the qualified wages of $10,000 and multiplying it by that 50% limitation to get you to the $5,000 credit.
Thank you, Paul. I guess we're getting close to the end of the webinar, but I have a question for you, Dave. As the pandemic is still not over, you mentioned that you had a discussion with Finra. Any word from Finra on further audit or focus filing extensions beyond March year-end broker-dealers?
No, they didn't comment on that at all. More like, let's wait and see. So there was really no feedback on that.
Thank you. So I guess more, and if we do learn of any developments, obviously we would share that with the participants.
Absolutely.
Yeah, thank you. I mean, those are the questions that we had got to the portal or before. I don't know if John or anyone else has other questions, but I'm thinking we should wind down now. I want to again thank all of our speakers. We really appreciate your insights and perspective, particularly in the midst of so much uncertainty going on right now. I'm confident that we'll get through this stronger in the long term. I want to also thank all of our attendees for attending today's webinar, and encourage you to certainly go on our website. The Citrin-Cooperman COVID-19 response unit has a lot of information in connection with COVID-19. And look out for future Citrin-Cooperman events. And please stay safe. Thank you.